Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights to help you master the art and science of diversified systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome, everybody, to the very first episode of Turtle Talk. I'm Rich Brennan, and I'm here with my fellow Aussie turtle, Adam Havriliv, and a true legend in the trend-following world, Mr. Jerry Parker. So we've created this podcast to have an open and honest conversation about trend following, its principles, its evolution, and why classic trend following continues to stand the test of time. So in today's episode, we're going to be breaking down the latest trend following index performance, highlighting rising stars in the space, debunking some common myths, and just for fun, putting Jerry and Adam under the spotlight. But before we dive in, let's check with my co-hosts. Jerry, great to have you here. How's everything going?
It's going well. Thanks for having me. I'm glad to be a part of all of this with you two. We're going to have a lot of fun. We've already been talking about what we're going to talk about, and my bottom line is we just got to have some fun doing it and talk about what we love. A new name, I'm going to start calling, instead of classic trend following, turtle classic trend following.
Exactly. Adam, how are things going down there in sunny Sydney?
Yes, very well. Thank you, Richard. Good morning to you and good evening to Jerry. Looking forward to our first podcast together.
Perfect. All right, so let's get started with our first segment. This is called the Battle of the Trend Following Indexes. So over to you, Adam.
Yeah, sure. So we've published the January report, and what we do here is we profile the classic trend index and compare it to a number of trend following indices, most notably the SG Trend Index and the Barclay B Top 50 Index and the TTU Trend Following Index. And what we're doing here is just basically tracking the performance of these relative indices and comparing and contrasting their performance. And January was a great month for Classic Trend. We had an up 3.7% month for the index. And so obviously we're off to a good start to the year. And generally all of the trend following indices performed well in January. And that is on top of fantastic 12-month performance for all of the indices, but most notably the Classic Trend Index. And you can profile or view this report at aussieturtles.com, and you can see there that there's a clustering of performance of the other trend following indices, and then a divergence of the Classic Trend Index. And I guess we're going to get into, why that is, why it's taking place, and why arguably that should persist into the future. But back to you.
Yeah, so the reason we developed the Classic Trend Index, and we'll include our reference to the Aussie Turtles website and the report in our show notes, but the reason we created it was to reflect a purist approach to trend following, focusing on long-term, diversified, systematic trend following models without the heavy overlays of risk-adjusted smoothing or volatility targeting that have become very common in modern CTAs of today. So unlike indexes like the SG Trend Index, which include large managers that often adopt methodologies to suit institutional mandates, Classic Trend is designed to highlight strategies that embrace the raw, unfiltered essence of trend following, cutting losses, letting winners run, and allowing outliers to drive performance. So tracking it separately as we do with the Classic Trend Index, it allows us to therefore compare how Classic Trend stacks up against broader industry benchmarks and the other trend following indexes and identify whether modern adaptations are actually improving or diluting the long-term returns. Classic Trend continues to prove why pure trend following stands the test of time. So its strong performance isn't just about catching trends, it's about letting outliers fully do their job while keeping risk in check. But if you look at the VAMI chart, you'll notice how it's continuing to diverge away from the rest of the indexes in terms of relative absolute performance with great risk metrics to boot. Now, a lot of people have questioned whether there is a true difference between classic trend and these other trend following methods. So they threw down the gauntlet, and that's one of the reasons we produced the Classic Trend Index, to demonstrate from a live track record of 3 programs that we know are classic trend. So that's Jerry's program, which is now TFPN. It's Moritz Siebert's and Moritz Hayden's program at Takahi Capital called the Systematic Trend Program. And it's our program, Adam, the ECCM Systematic Trend Fund. Those 3 we know categorically are classic trend, and that's why we've bundled them up into an index to see how they go against the other trend following indexes.
Yes, and you can see there from that report that you've done, Rich, on AussieTurtles.com, is that the performance over the last 5 years has been excellent. Generally, trend following performance has been strong regardless of the particular style of adoption. But classic trend does appear to have outperformed, and that's not just on an absolute basis, but on a risk-adjusted basis, it's doing very well. We're looking at MAR ratios of over 2 and a Sharpe ratio of over 1 since inception of the index.
Jerry, what are your thoughts?
Yeah, well, I think it's great. I think that the 3 programs included in the index are a great representation of classic trend following, letting profits run, cutting losses short, not having too much overlay and concern with volatility and drawdowns that would hamper the systematic approach that we have, and sort of trying to get out of Sharpe world. I love that statement that I think it was Dredge came up with. Really liked listening to him. He's one of the few that is not directly involved in trend following, but tends to say some of the same things that we say, and we like to hear said. So I think we want to trend following. It's not appropriate, I don't think, to use Sharpe ratio in measuring trend following. It goes against the philosophy of trend, letting profits run, and treating the profits much different from losing trades.
Yeah, having said that, Jerry, but I mean, the numbers actually over the last 5 years here for this index and the individual constituents have been very, very good. And so, long may these trends run. We're going to get into it later in the podcast. There are a number of factors driving trend, and arguably 2025 is going to be a fantastic year for trends as well.
I think it's, to some degree, I think that there is a right way and a wrong way to go about trying to achieve good risk-adjusted returns. And the right way, the way that always works well, is maximum diversification, and is far superior to overlays of adjusting trades based on volatility and correlation. So I'm all for a well-diversified portfolio. Then you take 3 of them and put them all together, and you can come up with a really good traditional risk-adjusted portfolio. That's the right way to do it, letting profits run and not taking small profits.
All right, gents, let's move on to the next segment. So the next segment is called What's Moved the Needle? In this segment, we're going to look at the biggest movers in both futures and stocks. And now it's early March, but let's step back in time, gentlemen. And can you walk through, both of you, the major material trends that drove performance in January? So I'll start with you, Adam.
Yeah, sure. Thanks, Rich. So, the big mover for the month for us was the US dollar. So the US dollar is strong across the board for January. And the currencies were weak, and we saw that the US dollar moved up substantially. So we've got a chart there of the dollar index in January, and I guess February we've had a little bit of a retracement, but that trend looks like it remains intact. Additionally, performance was supported by strong equity markets. So they've ended up closing at or near all-time highs across all the different regions, except for Asia, which, from our perspective looks a little bit weak. And then we've seen some interesting moves in individual commodities, most notably gold and coffee. So we've had all-time highs in gold recently, and some interesting news driving those markets. and then coffee having a very, very strong month, notwithstanding a minor correction in February. And, speaking of cotton, that's one that on the short side has been very, very weak, and that's obviously a trade that the short sellers have been making quite good returns on.
I've noticed we've had to say goodbye to cocoa, orange juice. They were my favourites for a while. So, they're proving quite difficult now.
Yeah, so orange juice, that's a huge correction after, a pretty strong run. And, the market has absolutely collapsed in the orange juice futures. And then cocoa as well, having a very volatile and then now a slightly corrective move.
Jerry, what were the big movers for you in January, and are they continuing? How's that going?
Well, we had some big movers in our portfolio. We trade some fixed income ETFs that in ETFs where there is not a futures market. So we have high yield bonds, mortgage backs, muni bonds, emerging market bonds, corporate bonds, tips. So all of those markets are pretty, and convertible bonds and preferred stocks. We throw all those in our fixed income sector, and those look much different than the interest rates, the futures interest rates, government bonds, where we're short almost all of those and long all of the ETFs that I just mentioned. So those trends have been very good, and they picked up steam in January and continues to do well in February. I'm still long my cocoa, and so I've got the loosest pants. Yeah, well, winter, but it was looking pretty good, before the sell-off, having stayed with the position. Not only stayed with it because of my exits are long-term breakouts, not chandelier or, and I don't do any fall management, correlation management. But not only that, but also, of course, I didn't reduce the positions based upon increased volatility. It always rubbed me the wrong way on a certain podcast that we all listen to.
Yes.
Where I think the host said last year that CTAs in January of 2024, as cocoa kept hitting new highs, they were selling cocoa all month or something like that. And I was like, oh my gosh, times have changed since 1983.
It seems a little bit counterintuitive to reduce your risk to an outperforming trade. If you're experiencing an outlier, why not just let it run?
Sort of flies in the face of trend following, doesn't it?
Yeah, it does. We, I think we just let the profits run. We treat them so differently. It's kind of weird that, what are you going to do in this trade? Well, you have to tell me if it's a winner or a loser. If it's a loser, I'm very concerned. But the loss is going to be so small. Yes, true, but I got to keep it small. I got to get out of this thing and deploy capital elsewhere and not warehouse risk, something I learned from Rich. And then we're going to maybe lose a few basis points or 10, 15 basis points on a losing trade. But on the winning trade, we'll give it, the drawdown could be 100 basis points.
Yeah.
The problem with not doing that is that it just works so well. And that's why we do it.
All right, gentlemen. Well, let's move on to our next segment. So this next segment's called Rising Stars and Trend Titans. This is where we highlight both emerging talent and established leaders in the trend following space. So in January 2025, systematic trend following strategies delivered strong performance with standout contributions from both seasoned managers and rising stars. So this report is coming from ATS Group's website. I'll have the link to the report in the show notes. But in this latest report for January, there were 108 globally diversified systematic trend programs that were included in the report. And it tracks all of these programs over at least a 5-year period. And then it consolidates all of those results to create a benchmark. So January's performance for the benchmark of all of those 108 programs had a 1.09% gain for the month. So that's generally reflective of the other indexes that we were talking about earlier. They all had a fairly positive month in January, albeit a small month, but it did have a fairly good start to the year. But its 12-month return for that benchmark of 108 programs, including all different flavors of trend following, was a 3.7% return. It had a 5-year CAGR of 7.16%. For the 5 years, and a maximum drawdown over that 5 years of 11.17%. So in general, despite the fact that the 108 programs has all of these different flavors of trend, it's generally fairly positive, demonstrating the power of trend following as a broad process. But within that benchmark, the report then looks at the top 10 categories in terms of monthly performance, last 5 years CAGR, and also we use a risk-adjusted metric rather than a Sharpe. We don't talk about Sharpe because we're not in Sharpe world here. We talk about the MAR ratio, which is the relationship between the compound annual growth rate and the drawdown. So from this report, gents, I'll ask your opinions about any standout performers in there. Jerry, what are your first thoughts about some of the performance there? You'll notice our friend Mulvaney is in there. Got anything to say about that?
Well, I'm just amazed by him. And I think it's great to monitor these younger traders and newer traders and the trend, all sorts of trend following that's going on. Especially I like the one that trades 21 markets. I'm really watching them closely.
That's Bowmore?
Yeah, it reminds me of when I first started trading. I traded about 21 markets, and then I made it my life's mission to trade 400 markets and trade as many markets as possible. And so one of us has it wrong, but we'll have to wait and see. They're doing so well, and I'm really interested in.
I've got a funny feeling about that. I know they only trade 21 markets, which at first you shake your head, but then they've got many, many systems deployed, trend following systems deployed. So I'm wondering whether the compound nature of all of those systems and the markets sort of does give them good diversification, but their results have certainly been impressive for the last 5 years.
I wouldn't think that if they were trading classic trend following systems like we do, that they would pick up enough diversification to compensate for the trading only 21 markets. And I don't think they do. I think in their interviews, they've talked about adding a few bells and whistles that we would not consider to be classic.
See how it goes. Adam, What stands out to you?
Well, interesting to see the dispersion of of results, even within that top 10 list. And if the average has come out to 1% for January, you're going to have some negatives and you're going to have some positives. So I guess even within the trend following space, people are taking different approaches, whether it be in the number of markets or the time frame or the multitude of trading systems or signals that they're taking over those individual markets. So you still end up with dispersion even in strongly trending markets like we're in now.
Yeah, good point. Look, I don't want to sing your praise too much, Adam, but you're a modest man, and I'm just going to raise the point that you are actually sitting as the number one fund in terms of MAR ratio for the last 5 years. You've had a stunning track record. Adam, what are the main reasons for your very high risk-adjusted return results?
Well, look, if you look at it mathematically, it's being driven by the maximum drawdown, right? So we've had strong returns, but we've had a relatively low drawdown. So we're sort of lucky to have launched the fund in a strongly trending environment, and then perhaps been somewhat fortuitous in the timing and execution of the strategy that we've got. But very, very happy with the results, Richard, and fantastic to have you on board as well. But, over the long run, I think trend following, it does well. Our approach is a good one, I believe. We're trading 77 markets at the moment, all futures. And we feel like that's a sweet spot for us in terms of execution capability and diversification, and also risk management. But looking forward to a great 2025 ahead.
Yeah, well done, Adam. Good results. So, look, we're going to move on to the next segment here. This is probably the main segment of the show. It's called Spotlight. And this is where we shine the spotlight on a guest. Now, given this is our first episode, we'll be redirecting the spotlight to the voices behind the mic, which is Jerry and Adam. So most people in trend following, they know Jerry's background. So today I want to talk about where Jerry is now. So Jerry, you've been in this game for decades, and while a lot has changed in the industry, you've remained one of the strongest advocates for classic trend following. So let's start with what you're doing today. What programs are you currently running, and what's the primary focus of your trading today?
Well, we have two ETFs and one mutual fund, and they all trade the classic trend approach with one entry, one exit, and a stop loss. And the total money management scheme that was developed many years ago. And the biggest change over these many years is just becoming longer term, looser pants, hanging on to the trends longer when our average holding period is of all the trades is about a year. And so, like I said earlier, when I started Chesapeake after the Turtle program, I was pretty obsessed with continuing just to add markets and make the portfolios bigger and bigger. And at some point, I sort of realized that the way to really start adding beyond 100 or 150 markets was going to have to be adding stocks. So we've been probably one of the few CTAs that trade stocks in our individual stocks in our trend following program.
Jerry, you've remained committed to the principles of classic trend following, but you talk about a bit of evolution in that you're also trading a large number of stocks today, that sort of stuff. So apart from going long-term and evolution, has there been any other changes to your approaches that remain very consistent?
Yeah, my approach has remained very consistent. We have tried to explore making massive changes, major changes, but it really just, like you said many times, it's just all about having a systematic approach that you can utilize for every trade that comes up, and then participating in those trends. And I think, I'm fond of saying that whatever point you want to make about trend following, you can make it with cocoa. And one of the points I can make with cocoa is how helpless you can feel if you don't have cocoa in your portfolio. And I know people who don't have it in their portfolio, who didn't have it. Not for any bad reasons, like, well, had never made money. That's obviously not a good reason for a trend follower. We're not supposed to look at individual markets or individual sectors or longs and shorts. We're supposed to look at all the markets, throw them in a big bucket, do the back test. How do they do? Close your eyes to any performance of any individual market or sector, or longs versus shorts. So if you could think about people who would spend so much time and energy in computing, in improving the system, yet nothing can improve performance as effectively as being long cocoa. And I think that's what I've learned over all these many years is you cannot miss a trade. You must put as many of these markets in your portfolio as possible. And there is no such thing as, well, I don't need to worry about this particular market or this whole sector. I'll just take a few from the sector, and that's got it covered. It doesn't have it covered because even in a sector like that where the markets can be highly correlated for long periods of time, maybe one of that sector will have a big, huge outlier trend.
It's interesting you say that because you're not the only one who says that. Like, I know Tom Basso's greatest regrets is missing out on that silver trade back a few decades ago. So for us outlier hunters, it's the type 2 error that's the biggest sin for us, so missing out on that monster trade, because as good as you can be in quant world, you'll never get what the market can deliver, like cocoa or silver or these massive moves that's well beyond our control. So you're totally right there. You can't afford to miss these monster trades, and that's why you need to be maximally diversified. But Jerry, you've been very vocal about what sets classic trend following apart from more modern day approaches that emphasize volatility controls and smoothing. So what's the biggest misconception you think people have about classic trend following today?
Well, that's a good question. I would say that, it's going to always underperform stocks. That's always the answer to the questions like this. Is the S&P. The S&P is not going to always go up. It's not going to always outperform diversification and trend following. And trend following, I think, is superior to the S&P index algorithm. It's not a very good. Some people call it. It has some elements of trend in it, but it's not a very good trend following proxy. nothing's going to beat the way that the typical CTA trend following approach and the way those systems are built. You're not there over time. It's not going to be any opportunity lost or opportunity cost by investing in trend following versus long only equities. There's probably no CTA in the world that trades 20 markets at least that could have as bad a historical performance as the S&P, an 8% return or 9% return, depending on when you measure it, a 50 plus drawdown. We step on the pitch with 20 to 120 markets for most people, longs and shorts, a systematic approach that cuts losses short. We just have too much of an edge over a silly long-only stock index.
Thanks for that, Jerry. Now over to you, Adam. So while Jerry's a household name, you've been a bit more under the radar. But you've built something incredibly impressive with East Coast Capital Management. So let's take a step back with you, Adam. What's your origin story and what first got you interested in markets and how did you find your way to trend following?
Yeah, thanks. Look, always been interested in trading. Just a question of how to implement it, and obviously the goal is to make money. So I've come from an investment banking background, on the sell side with a number of investment banks, and then I went and joined a hedge fund that was a long volatility hedge fund, based in Sydney, and their focus was trading long volatility directional with options, and that's where I got exposed, to trends. And it just piqued my interest in, is there a better way to exploit trending markets? Does a systematic approach outperform discretionary or fundamental analysis? And it's been a journey. It's been a journey for me, and a relatively long one. Notwithstanding, the firm has been around for a while, but the fund, we now have a 5-year track record, and the results have been good. I feel like we've developed quite a good approach, a systematic approach to trading trend. But in terms of inspiration, I think it's those classic books like Michael Covell's work on how to make millions in up and down markets. That's a fantastic book. And I think actually that's where I came across Jerry's track record. Jerry, you're profiled in that book?
Oh, yeah, Covell? Yeah.
In quite a few of them. And the Turtle Trader book that Mike wrote, that certainly features Jerry. But yeah.
So, I mean, there it is in black and white. And, like Jerry says, you can't argue with those numbers and those statistics. And it is puzzling why investors accept 50% drawdowns every 10, 15 years in the S&P 500, and then, as you described, nominal returns of about 8%. You would think if you, either you want to target that return and halve your volatility, or, for the same amount of volatility, you should be getting a lot more return. But his books are excellent, and we highly recommend them. And I think you can find those resources on our website if you dig around. In addition to a number of other books, that we recommend. But that's where those track records were profiled, and I think Jerry's track record is absolutely amazing, and you can just see it there, month by month, year by year, and just compare it and contrast it to how did equities do in that month or in that quarter or in that year, and where would you rather be? So, notwithstanding, it's been a journey, and I think we all go on these journeys as traders. But I'm definitely now 100% in the systematic camp. It's the place to be, and I think obviously it's been the place to be for the last 5 years, certainly. But in a world where there's so much uncertainty and I guess unknown unknowns, I don't really know what other approach you could take to trading markets. Because a tweet there or an event here can move markets so rapidly, and our assessment of what the future is going to look like is just changing on a daily basis. And yet, this strategy will adapt to those changing environments.
So, look, between the two of you, we've got over 60 years of trend following experience here. So, look, before we conclude this segment, I want to hit you with some quick fire questions. So, let's start with the first one. So, I'll go to Jerry first and then to Adam. So what's one common mistake you see traders making today? Jerry.
Oh, wow. Well, I think the systems are too complex and they're too finely tuned, and they're trying to get rid of volatility. Yeah, I think that's the plague of putting someone in front of a computer with a good brain and lots of data. It's just, you can't stop. You can't stop with the more parameters and the more rules to smooth things out. And I've never heard anyone really, except the few of us who we mentioned already, Moritz and all of us, who don't think about Sharp. I mean, it's obviously risk-adjusted returns mean Sharp, and of course, and it leads to all kinds of bad ideas.
So Adam, what's the one common mistake you see traders making today?
Probably an overfocus on one or a select group of markets, right? So, if you're just focusing your time on the S&P 500 or, a single stock, and then maybe, a commodity like gold, you're really missing out on a plethora of opportunities that are out there. And once you go down that rabbit hole, the only way to really apply capital to many, many, many markets is a systematic approach. So, if I was giving any advice to traders, I'd say step back, take a look at all of the opportunities that are out there, and don't just focus on one individual market and have a relatively large exposure to that one market, but spread it out systematically over as many markets as is possible.
All right. Now, look, I know Jerry's only got a hard stop coming up and he needs to get out of here, so we'll keep this to 2 questions. So I'll go to the last question. So, Jerry, to you, what's one book, quote, or concept that has shaped how you trade?
Oh, well, I think, Richard Dennis had lots of good quotes, and there's so many. But the one that comes to mind and that I really like is do the right thing, do the hard thing. Trading should be tough and it should be hard. And your mentality should be, I hope to get out of this by making some decent money and not losing too much of my money. Don't get your hopes up too high. Don't set the expectation too high. It's going to be hard. You're not going to stumble onto something that no one's ever seen before. More than likely, most of us won't do that. So I think trading is a difficult business. You're going to have lots of hard times. There's nothing wrong with your system if you go through a nice drawdown. Don't give up. Don't stop. Don't try to rewrite everything that you thought was correct. You're probably on the right track if you're diversified and you're trend following, and you listen to podcasts like this, and so many people are giving great information on. But there is no holy grail, and I think. Do the hard thing, do the right thing, follow your rules.
Okay. Adam, one quote, book, concept that shaped the way you trade?
Okay, well, so my concept, I think following on from what Jerry said, yes, the information is already out there. Okay, and I've got 2 books to recommend, being Covell's Trend Following, which we've already discussed. That gives you the historical background on the trend following traders' performance over decades and decades, and it's all there in black and white for you to see. And then I would combo that with Manias, Panics, and Crashes, right? Which basically puts in context those track records, because trend following often performs in the most crazy of times, right? So whether they're crazy bull markets or crazy bear markets or some moderation in between, effectively, trend following seems to do very, very well during those periods of time.
No, that's great, guys. Thanks very much for that. So, look, that concludes our spotlight section. But before we go, I just want to give everyone a heads up. So, Jerry, we've got a special guest coming on next month. Do you want to announce who that's going to be?
Yes, we are planning to have Salem Abraham, who's been a trend follower for many, many years as well, and he's now ventured off into slightly different strategies of managing money. But so tune in next month for a good. We'll pepper him with lots of questions. I've known him for a long time. We used to do research together, and he was a great trader. Salem's one of the best at looking a drawdown in the face and not blinking, and not, once again, doing the next trade. It's as simple as that. Whatever it takes, just do the next trade. Trade a little bit smaller, Trade a lot smaller, whatever it takes. Just don't stop trading, whatever it takes. Make sure you can always implement your system. And he was, you can't teach that sort of stuff. He was just a tough as nails guy.
We're looking forward to that. So, Adam, over to our next segment, Turtle Tidbits. Over to you.
Yes, so Turtle Tidbits. Here we explore the principles and philosophy of classical trend following. So, obviously, we are advocates of this trading approach here on this podcast, but there are other approaches to markets, and we're here to advocate on why the classic approach is superior. So, Jerry, do you think that you could outline, what is classic trend following?
I think I can. I'm sure I can. Now, whether you two are going to agree with me or anybody else is going to agree with me, that's up for debate, and feel free to push back. But one entry, one exit, and a stop loss. I think that is the core of trend following: an entry rule, an exit rule, and a stop loss to keep losses small. So that to me sort of sums it up. Trading all markets with the same strategy, with the same system, the same entry exit. That's got to be part of classic. This counting the trades, being able to count the trades, an entry and an exit, an entry and a stop loss. I think a lot of the managed futures CTAs these days, they are not able to do that. There's massaging of the portfolio hourly or daily, or of buy a little bit, sell a bit in all the different markets based upon what the portfolio is doing and what the volatility is doing or the correlations are doing. So this sort of discrete systematic approach that you can apply to each and every market and count the trades, and all the trades are done the same way. The entries and exits are all the same strategy. I think this is some of the hallmarks of classic. I may have left something out. Did I leave anything out?
No, I think that covered it. Max diversification. Yeah.
Not paying too much attention to. I'm going to get into this later, but I think the money management is sort of built in with the diversification, the longs and shorts, treating the longs and shorts the same way. The stop losses, part of the money management strategy. So the trend following is just this combination of following trends and making money, and then also inherent inside of it is this great way of preserving capital. In my opinion, one of the keys to what we do, I think we all handle this in a similar way, which is almost no one else would do this, and that is we're very careful. I'm going to choose my words carefully, so try to encompass what we all do, but we're very, very careful about including open trade profit into our trade level, into the number that we use as our assets under management to size the trade. So I'm very careful to not include very much, if any, of my open trade equity of the cocoa trade and the coffee trade and the orange juice trade, as that is just fluctuating around all the time. So I want to treat each trade the same way. I'm using the same entry, the same exit, and the same stop loss. The sizing algorithm based upon volatility / ATR, they're all being sized in the same way. And I kind of want the trades to be the same risk and keep my trade level that I use to size those trades with to risk a certain percentage of my assets. I want to keep that as constant as I can as well. Hell, I'll be making money. I'll need to increase it at some point. I think including a lot of the open trade profit that comes and goes because we're so willing to let it fluctuate is dangerous.
Yeah, I'd agree. I think the foundations of classic trend following is targeting these outliers, and that necessarily therefore gives us a more bumpy ride than many other players. But to me, it's the outliers, the material moves that actually drive long-term returns over the long time. They're the things that create the compound annual growth at the end of the exercise, these material moves. And to try and target these massive moves, you need one entry, one exit, a trailing stop in my case. You're a bit looser pants than me, Jerry. But the idea is you let these things run for as long as they endure, and no one can predict how long they endure, but it's essential that we let it run. Any form of tampering with that letting run concept, to me, is crucifying the entire philosophy of outlier hunting. But
yeah, so I think that's where the classic approach shines. Or you want the tails of the distribution, whether it's on the long or the short side. And so it makes absolutely no sense to me to vol control winning trades. So if volatility is expanding and trades are moving in your direction, it makes no sense to me to reduce risk in that sort of environment, because we don't know. Is this going to be a 40 ATR excursion? Is it going to be a 20 ATR excursion? Is it going to be a 60 ATR excursion? We don't really know the answer to that question. And, we're effectively dealing in non-linearity at that point. And so why fade yourself out of that, and what then reinvest it in some markets that are performing normally, quote unquote normally? No, like stay in the tails. And obviously we need good risk management to do that, because we don't want to have a risk of ruin that's material. So it's all about sizing positions correctly, being able to play in those tails, and having as loose as pants as one can bear.
it's interesting. A lot of people talk about our volatility, but as we've seen in the prior discussions we've had in this podcast with the comparing us against other trend following indexes, etc., for the last 5 years, we can demonstrate this massive lifting power with low drawdowns, and that's because of our massive diversification. So they talk about all of these other methods, volatility control and all of these things, to smooth the ride for the investor, which does compromise the ability to capture these outliers as far as I'm concerned. But with our method of maximization of diversification, that actually is assisting us to smooth our returns while not compromising the lifting power of our process. So that's where I think the distinction exists. I think we are not compromising lifting power or compound annual growth over the long term, whereas I personally believe that these other methods of smoothing the ride for investors, it appeals to investors to give them the smooth ride, but I think that is not in their interest in the long term.
Well, as you say, Rich, the real world is wiggly, and people don't necessarily want to hear that. But if you're going from point A to B, there might be some bumps on the road, and the question is, the goal is to basically size your position in a way that you can avoid the noise and not get stopped out of monster moves.
Yeah.
I think it's problematic to define risk as volatility of mega open trade outliers. I can't believe I left off outliers. Of course, it's the whole ball game, hitting these outliers. So, but I think just the mistake of defining a drawdown in cocoa when you're a third of the way up to where it's going to end up going is silly. It's the risk of loss of capital is what we want to minimize. And we got those small losses. We've got the small bet sizes. But the whole point is the computer is telling us, if you let those profits run and take small losses and treat them differently, this allows you to make more money, and then allows you to be disciplined and follow your rules. And so, and if you're going to follow these rules, the fewer the rules, the better. The whole point of following rules is that things you don't like are going to happen. What happens when you don't like it? You keep following it, and you don't keep coming up with more rules.
Yeah.
My goal in life is to have more rules to get rid of those unfortunate periods. That just doesn't make any sense. It's not doing the hard thing, because that's the easy thing. And convincing yourself that, we live in a sharp world and we're going to turn trend following into something where sharp is relevant, which is totally missing the whole. But it's good. I mean, we're in this niche where there's like 5 of us. So I'm not. I'm not jealous.
We can stand out from the crowd.
Yes.
Yeah, I mean, if markets are going to be volatile, and we know they can always get more volatile, I think that's where the position sizing comes in as an essential ingredient of classic trend following. And I don't know, my experience, I don't know if it's yours, Jerry, but over time, you just realize you don't actually have to bet that much on any individual trade to have material results. So I'm thinking back to palladium in the last 5 years. I'm thinking back to cocoa. I'm thinking coffee, even the S&P 500 and equity markets. You don't have to take very, very big positions because we're relying on large moves, which are basically unforecasted, right?
And hopefully, if history is any guide, we'll get mega trends in 5 to 10% of the markets that we trade. So it doesn't really matter which markets we're in either. We don't have to be in specific markets. Even if you didn't have cocoa, but you traded some stocks, maybe you would probably over time pick up some great trends in some of the stocks that you trade that other people wouldn't pick up. So there's no reason to lose hope in any 1 year or a few years if you're not in the biggest markets, because there's a lot of cocos in the thousands of stocks out there.
Yeah.
So there's no such thing as markets that are superior trenders. The S&P is not a superior trender. They're not superior in any way. They're all sort of created equal when you put a trend following overlay on top.
All right, gentlemen. I know, Jerry, we've got about 8 minutes left before you've got to bail. But look, what we might do is we might do the Mythbusters segment, and then we might drop the gossip column segment for this episode, and we'll bring it back next time when you've got a bit more time. So let's move on to the Mythbusters segment. This segment's where we take a closer look at some of the biggest misconceptions in trend following and set the record straight. So today's myth is one that, let's be honest, raised a few eyebrows when it was first uttered by Jerry Parker. But the myth today we'll be busting is risk management will kill you. So what's going on here, Jerry?
I'm laughing at my own statement. And of course, I had to, my goal would always be to come up with something that would turn heads of the listeners and my co-host. I want you guys to say, what the hell is he talking about?
Yeah.
What have you said now, Jerry?
Yeah, we've sort of talked about it a little bit. And that is, we want this risk management that we have in classic trend following, turtle classic trend following, we want it to be embedded. I'm suspicious of an overlay. Every time I hear about risk management from managed futures CTAs, all I can think of is it's going to impact my one entry, my one exit, and my stop loss. I'm not going to be able to do those trades because something has happened in the portfolio or in a sector or in a market that a new rule is going to pop in and say, risk manage, get that away. There's too much volatility. There's too much correlation. We're not going to let you have these loose pants. You have them in theory. The system, if it was allowed to operate on its own, would stay in the cocoa trade, but we had to get out of cocoa because of risk management. So I think it's just analyzing that the classic trend itself, as we've already stated, with fixed income, foreign exchange, stocks and bonds, longs and shorts. Now we're starting to build on this massive diversification that no other strategy can match. We have stop losses. We have a exit strategy to protect the winners. We're going to try to be as consistent as possible, and choosing the right size to trade and trading smaller and not risking too much and having these small bet sizes helps us preserve our capital during the drawdowns and in the periods where we're not making money at all and the markets are very choppy. So I guess the point I'm trying to make is let's do all we can to embed into our strategy risk mitigating parts that trend following has and rely upon them so we can actually follow the core system and do the entries, do the exits, and do the stop losses without having this oppressive money management overlay that to me looks a lot like profit taking and appeasing clients. I mean, you said earlier, a smooth ride for investors. Give me a break. Some of this smooth ride is for the manager. He's blaming it on the investor. Well, these investors won't sit there with these drawdowns. Look, they'll sit there if you've got a guy like Mulvaney and CTAs who are letting the profits run in cocoa. They'll sit there for a long time and understand how important it is to allow for some volatility.
Yeah.
What do you think? push back a little bit.
No, I can't really push back, because what you're saying, and this is what I'm hearing, is that all of these complex overlays, they are affecting the key foundational principles of our entire method. Small bets, initial stop, trailing stop, or single exit. All of this complexity to me is a bit like overfitting. It's overfitting a result to produce some other result. By tampering with that very effective method that we've seen works over countless sample sizes, because we're talking about trend followers that have been in existence 50, 60 years or whatever. We've seen it work. Small bets, initial stop, trailing stop. The industry's brought in this complex overlay, and all I'm seeing is a deterioration of the foundational principles of trend following. The returns, the compounded annual growth rate, the lifting power, and the diversification. It's all getting messy, and it's getting compromised by complexity, which is stepping away from our foundations or our roots. So that's how I see it.
One of the fertile rules that I think is one of the greatest rules of all time is that, well, wait a second now, what if we have a drawdown? What if we're having a drawdown by our definition and by our strategy and rules is a drawdown that's uncomfortable? We one of the things we proclaim to do is stay in the game. You have to stay in the game. You can't hit a risk of ruin point, which could be minus 50 or 30 or 20 or something. So what do? Well, we have the cutback rule, where we will reduce our positions by 10 or 20% based upon our formula, and then reduce the future trades for a while at that same rate. And this allows us, this is the most remarkable rule, because it allows us to reduce our risk of ruin. The turtles used to reduce, we trade a lot larger, lots more volatility, a lot bigger drawdowns. And so if we were down 10%, we would reduce our positions and our future trades by 20%. So twice that rate, to try to make a further fatal drawdown or uncomfortable drawdown even less likely. But what the key to this rule is that it allows you to go back to trading the system and not deciding which trades you're going to pass on or how you're going to handle exits. Well, I'll get out of exits quicker now because I'm in a drawdown, I'm in a defensive position. So everything that we do and how the systems are created, every element of the system needs to always encourage us and allow us to follow the rules. So we go right back to following the rules, except we're trading smaller. And this is a brilliant, simple money management rule. Now, I have seen people do studies of this rule, and because the turtles were trading so large and having frequent drawdowns and having frequent cutbacks, it really defeated this goal of being able to stick to your system. So I've seen people do the research and analysis saying, no, if the turtles would have traded smaller and not hit these cutbacks so often, they would have made more money than the alternative. And that's exactly true. You'll never make as much money with any sort of money risk management overlay as you will trading the core system. And that's the bottom line. You want to choose a trading size and volatility and risk budget with that in mind. And you may have to do it, and you may have to preserve capital. You may have to do whatever it takes to stay in the game, but it is suboptimal. So you want to set your leverage and your volatility to a level to where it's very unlikely that you'll have to make anything close to a frequent cutback.
All right, gents. Look, unfortunately, we're going to have to move on to Shell Mail. Jerry, your time's running out. So Shell Mail is our segment where we invite questions from listeners, and we've got some great ones this month. So look, to keep things quick, we might do two of them this podcast, and then next month we'll include the third one. So the first question is from Lee Hancock. He's someone who's been following our trend following discussions for a long time, and Lee writes, "G'day, Adam, Rich and Jerry. Hope the trends have been treating you all well. Super excited about the new Turtle Talk. I missed the weekly Twitter spaces. Don't we all, Jerry? Please feel free to answer these however you like." So to you, Jerry, in some of our recent podcasts, you've mentioned wishing you had time to learn from Rich and Bill. That's Rich, Dennis and Bill Eckhart, not Rich Brennan. 4 years just wasn't enough. With experience and hindsight, what are some things you now better understand that Rich and Bill told you back then, but could only truly grasp through experience? And what are some of the things you wish Bill and Rich could have taught you that would have saved you a lot of stress, whether financially, emotionally, or in managing a fund?
Oh, very good questions. Wow. I think, some of this just takes experience. You're not going to be that great when you first start. And so we lived in a pretend environment, in a pretend bubble where you got rewarded for following the rules and doing the right thing. And they would say, if you lose money, but you're doing this, you're implementing the system correctly, it's okay. If you make money by not following the rules, you're going to be in trouble. So that doesn't exist in the real world. Clients want you to cheat and do whatever it takes. If you figure out when not to follow your system, and if that makes more money, I'm all for it. So I think just being there and going through more years of the ups and downs in the markets and continuing to have that encouragement and that feedback of you're doing great, even though you're losing money, I think is just invaluable. And that is why, the turtles had such an edge over just reading a list of rules, reading a book, which I'm sure they're great, versus actually being there and having that feedback. Trading so large was, it took a while to get out of that mode of short-term trend following and trading so large. I think the longer-term, medium-term trend following always worked, or probably always worked better. And just the psychological torture of going through 200% returns and 50% drawdowns is just I wish we'd have traded evolved into more of a longer term, trying to make 20% rather than 200%.
All right, Lee's also got one for me, but look, we've covered a lot of that in this episode so far, but he says, having listened to literally over 1,000 hours of trend following discussions, well done, Lee, it seems like volatility targeting and having different systems, e.g. Jerry System 1, Jerry System 2, etc., ultimately lead to the same net result. Are they really that different? We're all friends at the end of the day, so why does the debate over this feel more intense than it should be? Now, we've already gone through a lot of this in my philosophy, but the bottom line to me, Lee, is I do think this debate matters, and I think it's because at its core, this debate is about altering the fundamental goal of trend following. So I'm very passionate about the processes of classic trend following, and this is from it's not only the readings I've done, it's my intense research that I've undertaken in all of my years here with the principles of classic trend following. And I think that these points do matter. As much as we are all friends, I don't think there's any problem with having different opinions. However, I'm very glad I'm in the classic trend following camp. I will always support the classic trend following camp because all of the other things I hear about are compromises to that foundational principle. And what that means to me is an absolute compounded annual growth rate over the long term. I don't think there is any way to improve what we've got with this classic trend following. So enough said from me, but look, we might have to leave the questions there. So for next episode, we'll be responding to the questions from Jason from Canada and Marcelo from Brazil. So thanks, gents, for bringing in your questions. We won't be able to get it to you this episode, but we'll definitely address them next episode. But we've done it in order of how we received it. So that's why Lee was able to get his question to us for this podcast. So, Jerry, I know you've got to go soon, so we might now just wrap up this podcast, episode 1, our inaugural episode of the Turtle Talk podcast. A huge thank you to both of you, Jerry and Adam, for your insights and for having such a great discussion this episode. So we've covered a lot today, from the battle of the trend following indexes to shining a spotlight on Adam and Jerry and busting some myths that Jerry has, which we'll be doing each episode. Next month, as we've mentioned, we'll be putting Salem Abraham under the spotlight, so you don't want to miss that one. And if you've enjoyed today's episode, make sure to like, subscribe, and share the podcast. It really helps us keep these conversations going. And if you've got questions, thoughts, or topics you'd like us to cover, send them in for next month's shell mail by going to the Aussie Turtles website. I'll include that in the show notes, and go to the Contact Us page and send your questions through to the podcast. So thanks again for everyone tuning in, and until next time, may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time. And as always, may the trend be with you.